Hi everyone, good afternoon. This is Colin Tierney at Sageworks. We are about to start the presentation today. I wanted to take a couple minutes just to introduce the presenter and talk a little bit about what you're going to see here, and then he'll go through the detailed agenda and also kick off the presentation. So we'll move forward. You're going to be hearing from Zeb Zeiler. Zeb is the project lead for Sageworks Valuation Solution, and he works with a team of people here to generate content that is ideally incredibly useful for the people that we work with on a daily basis. So we'll speak with hundreds of business valuation experts every month, and in those conversations we like to do some fact-finding and figure out what's going on in their world and obviously how we can be useful to them with our products, but also with the content that we create. So that plus our own research and leveraging the research of other reputable organizations, we like to compile some information every once in a while and put it into a webinar and then push that back out to anyone who might be interested. So we appreciate all of you being here today, and there will be a follow-up going out after this that will include the presentation and some other notes. So look for that as well. So moving on, just in case you have any questions, you can enter those into the question box in the dialog prompt there, and we will take those at the end of the presentation. So please enter them. Don't feel bad if we haven't responded immediately, because we'll get to you guys at the end, and we'll pick out a couple to answer live. So if you have questions, please feel free to enter them there. And then next slide, just to talk a little bit about Sageworks, and then we'll dive into the content of the presentation. So if you're not familiar with Sageworks, we've been around for about 18 years now. We are based in Raleigh, North Carolina. We're a technology company that serves the financial industry and serves actually a number of different types of businesses in the financial industry. And we're going to talk today specifically about business valuation and what we do, and also what content is most useful and what information is most useful to help people in that space grow their business, and where we've seen some insights that can be truly valuable to those folks. So if you have questions about Sageworks, obviously feel free to get in touch with us afterward. The bulk of this presentation will not be about our products, so if you do have specific questions, just feel free to reach out afterward, and we'll happily answer those. So now I'm going to transition over to Zeb, and he's going to be kicking off the rest of the presentation today. Lots of good stuff to talk about, and like I said, feel free to ask any questions through that prompt in GoToWebinar. All right, Zeb, go for it.
Thank you, Colin. So I appreciate everyone who's investing their time this afternoon. As mentioned before, we speak with hundreds of BV professionals each month, and through those conversations, we want to share what other firms are doing to create subsequent BV work, as well as create new consulting opportunities. I'll be focusing on the insight I've gained through those conversations to give you, the audience, an idea of what the masses are saying, and also what forward-thinking firms are doing to take advantage of many of the opportunities in the industry. Today's agenda, we're going to first talk about where the bulk of opportunity is sitting, how other firms teach clients what actually drives value and which creates conversations that lead to providing the service. Through that, we'll want to look at some of the low-hanging fruit that could really help you in those conversations. We'll then look at how our customers leverage essentially what-if scenarios to provide a visual impact and solidify their value. In conclusion, we'll then talk a little bit about the action plan firms are using to scale in a growing industry, and a little bit about technology's role within that. So CPA roundtables, Accounting Today, AICPA, all have said that the bulk of clients in need of evaluation are more so or equally in need of consulting. Growth in the valuation industry is happening obviously right now and is only going to increase in the future. So what we're looking at is over 65% and or 16.8 million privately held businesses that are expected to go through some kind of transition over the next decade. So what does that mean for your firm? Well, it means that business valuations are essentially what I say is the same as the coffee industry. I mean, it's a $7.4 billion industry over the next 10 years. the problem is that there's only 25,000 professionals nationwide who are credentialed to provide the valuation. So most firms really are not ready or prepared to take advantage of the huge revenue streams because their current process essentially limits them in how many new engagements they can actually take on. So I want to do a quick poll question here. What percentage of your clients or your business clients are over the age of 50? Go ahead and launch this poll. Okay, the poll has been launched. Okay, we have about 85% have voted so far. Okay, we're wrapping up on about 90% have voted. If there's anybody that hasn't voted yet and you want to jump in, give it about 10 more seconds here. Okay, we have 90% voted. I'm going to go ahead and close out the poll. Okay. So I'm going to share it with y'all. This is very interesting. That's actually right in line with IBIS World's and AICPA stats as to the percentage of business owners in the nation that are essentially, it's around 65 or over 65% of the population of business owners are in that 50 and above age range. So this is right there on par with what we're seeing. So that was an excellent poll that kind of really helps to go off of what we've already kind of read about. So that definitely is very useful also for us when publishing and republishing back to our content and also working with AICPA and sharing that with them. So they're very interested in this information as well. So that's perfect. So what I did is I essentially wanted to quantify the scope of opportunity. I'm going to use the state of Pennsylvania just as an example here. So with the ever-increasing supply, well, before I move on to that, essentially what I looked at was the census.gov information. Looking at the most recent information I could pull was 2012. It's about 300,000 businesses that were non-farm establishments, and then looking based off of IBIS World stats, I was able to get an estimated number of boomer-owned businesses being around 118,000. That gives us about, looking at the square miles of Pennsylvania, it's about 2 to 3 boomer-owned businesses for every square mile that you drive. I've done this when speaking at the NACFA state chapter conferences for CPE credits. I've done this for almost every state that I've traveled to, and it is almost always somewhere between 1 to 3 boomer-owned businesses for every mile that you drive. So with ever-increasing supply of business coming into the market, as boomers retire, price multiples for businesses may decrease. We all know supply and demand, right? So increasing supply lowers price. Only well-prepared businesses will sell, and only the best prepared businesses will command the highest price multiples, right? So unfortunately, many CPAs and their clients get trapped in the same old routine, accounting, preparing financial statements, tax planning, tax prep, and obviously the cycle continues. So the compliance and reporting services obviously are critical, but so is proactive planning. So time simply gets away from us, and then one day the realization hits, there were things that should have been done years ago before the client decided to list the business for sale, right? So CPAs and valuation professionals should take every opportunity to talk to their clients about their exit options and implement a strategy that will interest prospective buyers and assure lenders that financing is in fact viable. Right? So trusted advisors should bring up the subject at the very least as a part of the annual meeting. On a personal note, obviously I realize that owners are resistant to spending money on business planning, but in my customer's opinion, times are changing and waiting is no longer an option. Clients need to understand the significance of the baby boomer mass exodus and how that may impact the value of their business. Think of how the flood of businesses entering the market, or aka supply and demand, will affect, therefore, even the value of, say, millennials or Gen Xers because of the mass exodus of boomers, right? So our customers believe that they must explain how the price their client may receive for their business will be determined based on two factors. One, market competition. So that's a great time to talk about the baby boomer mass exodus. And or B, the cash flow, growth opportunities, general condition of the business when it's put on the market, which is obviously a good time to talk about unexpected exits due to illness, changing family circumstances, things like that. So it's a pattern that is replicated across the U.S. every day. Business owners excited about the prospect of selling their business and moving into the next phase of life, they're essentially confronted by a stark or a realization that their business value is nowhere near what they expected or what they need to finance their desired future lifestyle. So they face what we would call a value gap, and in determining how to close it, they often, based off my customer feedback, choose the wrong path right from the outset. The value gap is in almost every conversation you'll have, and it's also where our customers see a key in opening up a new opportunity. It's a well-documented fact that in order to build value, a business must generate profitability in excess of its cost of capital. We also know from various studies, research, and experience that most privately owned businesses do not meet their cost of capital threshold and therefore are not creating value. Such fact is often manifested in valuation results, but without proper guidance, business owners are left believing that their only options for building value is to grow sales, reduce costs, or acquire another location. So in effect, business owners will typically only understand one side of the equation. And therein resides the opportunity for you, as their advisors, to educate them and show them a better way, right? Profitability needs to be greater than cost of capital, then the value will increase. The business owners typically only understand the profitability side of that equation. So attempts to aggressively increase sales will often come from undesirable side effects of adding risk to the business because the organization is not properly structured to absorb the growth. So this type of growth is not sustainable. Further exposes the business to increased risk, which in turn, the business's cost of capital, or aka discount rate, and essentially it'll raise the discount rate, and that can result in a lower value despite higher sales. Increased sales may also come at the expense of margin erosion if the business's sales are also grown by reducing prices in a competitive environment. So that in turn can start the downward spiral into commoditization, and the business must then begin reducing costs in order to preserve their margins. So reducing costs, however, often mean either eliminating positions or sacrificing quality of some element of operations. Eliminating positions usually means adding more workload to an already thinly stretched workforce, while sacrificing quality eventually leads to inferior product and service or lost future revenue. So both outcomes reduce the business's sustainability, increase its risk profile, and therefore increase its discount rate or cost of capital, and reduces its overall value. So that may affect also, if you think about employee loyalty and retention, going that route. So there's another way. Essentially, my customers tell me that the route to go is a way to maximize a business's value. It's easier, it's more controllable, more predictable, more sustainable, and more effective than chasing sales or margins or making an acquisition. It doesn't even require growth in sales, margins, or profitability, but making it even more appealing, growth in these categories typically follow as a byproduct without reducing prices or adding more risk to the business, right? It's the process of strengthening the business from the inside out by reducing its risk, which in turn reduces its cost of capital and discount rate and increases its value. So if it's easier, more controllable, more predictable, more sustainable, and more effective to build value from the inside out, why don't more business owners engage in that process? Well, the answer is that they aren't aware and generally have no knowledge or understanding of the impact of risk on their business's value. They may also not appreciate the value that an advisory board may bring to implement and sustain their initiative. Therefore, it is up to their advisors to educate them and help them through the process. It also means thinking about your service approach a little differently and exploring tools available to help improve the value propositions. So if you do so, the incremental value opportunities you can create for your clients and the incremental revenue streams you can create for your firm can actually become compelling. I like to use this example that you're looking at right now from the founder of Corporate Value Metrics. He made a great point when showing that the increase in value for a company that reduces their risk only is the same as a company that doubled their sales but increased their company-specific risk premium in order to achieve that sales growth. And the same thing for the increase in company-specific risk that a company that was just trying to cut costs. Essentially, it's break even. So what we're proposing is that the best way to go about it is to focus on finding the risk inherent in that business and helping them strengthen the entity from the inside first. That will organically increase the overall value of the business, right? But a byproduct is very common byproduct is actually increased sales, margin, and the overall profitability of the company just because they're strengthening it from the inside out. So with that, when I'm training or consulting with our current customers, a lot of the times I'll get asked questions, Zeb, where are some areas that we can identify risk, right? Some of us, are a little bit newer to the industry. So, this is going to be, this is actually, even though it's a couple slides long, it's actually a rather short list as to what I have here in-house. So I put together this source from Dr. Carl Sheeler, PhD, ASA, CBA, CBA. He's the director of Berkeley Research Group, LLC. It's a firm that's staffed over 650 professionals in litigation advisory. His focus is on 8 to 10 figure family business offices, and also he's done over 1,000 IRS court qualified valuations and testified over 160 times. So I'll use this because what I appreciate about this information is the fact that there's a percentage of how common it is that you would find this in each business that you sit with. So I put them in different buckets. One is the planning bucket. So I know we've been on this screen for a minute, so hopefully everybody's had a second to read it. Your next bucket is going to be your financial awareness. So you're looking at, a lot of times the business owners don't have a budget or forecast. They don't understand cash flow. They have limited knowledge of the financial statement performance for their industry, so they don't even know how they stack up against industry peers, right? I call this the intangibly tangible bucket or common sense. It doesn't really fall in any other, any one category or the other, but it should be kind of known, like, how does this company leverage their technology, right? Or is all the employees siloed, right? Is there any cross-training of the employees? Because that makes them a little bit more flexible, right, with talent turnover and things like that. Another one is the concentration of clients and vendors. If you think about that, if you have a client or their company, 2 clients make up 60% of revenues, well, that's pretty risky, right? So we want to go ahead and get into creating the conversation where some great questions to ask your client. Do you have a retirement date in mind? When do you think you're going to retire? What price do you have for your business? Like, what price would you have in mind? Do you understand what the tax consequences are on a sale of your business? Do you think that you know or might be able to, do you think that, what do you think your business would go for if it was sold today? So our suggestion is to do more than just talk. Once you understand your client's goals, discuss options to achieve those goals. You want your clients' buy-in on some of the actions to help get them to where they want to be. So you want to identify things like housekeeping chores, tending to look at like updating systems and technology. So essentially your clients won't know how to reach their goal without knowing where they stand now. So a good service to offer is an initial calculation of the value of their business, because how can we build a conversation on where their goals are and where they want to be if they don't at least know where they stack today? So you can position yourself in a way where you can help them at least understand where they are today, and then that can help you build a battle plan with them, creating subsequent ongoing consulting work. Also, a big one is a very common first project that firms who offer BV work and consulting services would be the cleaning up the depreciation schedules. It doesn't really seem like it ranks high in accounting priorities, but basically it's extremely high priority when it's time to sell the business, right? A lot of the times my customers see that the current depreciation schedule listing, they're no longer owned by the business. So that actually, the depreciated value is not the fair market value of the equipment that the company owns. So that's very common for BV professionals to run into. Another important area or aspect to cover is the importance of annual financial benchmarking. So your clients have to know where they are now before they can take steps to get where they want to go. So benchmarking can pinpoint how the business stacks up compared to the industry peer group. So for example, worse than industry peer group may indicate a lower than average valuation. Equal to their industry peer group may indicate average pricing multiple. Or better than the industry peer group, it could also help indicate an above average pricing multiple, right? So once you've had a chance to review the benchmarking data, communicate the results, and provide advice on how the clients can make improvements. Remind your clients that the business that performs better than the industry peer group will most likely receive a better sales price when it's time to sell. So leveraging what-if scenarios, and kind of going back off to what we've already looked at, is companies' purchase price is based upon as is, not based upon what it could be under new ownership, except for cases with synergistic buyers, aka a guy who owns 3 plumbing outfits and is strategically looking to acquire a 4th. So unless you're in the business of going out and trying to find a synergistic buyer, you might want to consider the best way to help the client is to get their business ready to sell as is. So a home is usually, it can be a useful metaphor for financial professionals to consider as they try to generate repeat or subsequent valuation consulting work with their business owner clients. Home sellers know that the first step to selling a home is getting it ready to be shown to potential buyers. And home buyers know that a fresh coat of paint, a clean yard, and a functional doorknob can really make it a little bit more appealing, right? So looking at business in contrast to looking at a home, you look at business optimization. That would be for a house, maybe highlight the remodeled kitchen, something like that. Or the second step might be in a business risk mitigation. In a home, it might be finding leaky pipes. And then for a business, you might have future sustainability and growth. For the home, you might be, compared to that might be things like new schools or shopping centers being built in the area. So a great way to start is through obviously a simple conversation. I've heard a lot of my customers tell me that they simply ask their client, what do you think your business is worth? And after hearing the client's answer, they'll ask, okay, what would you be willing to pay for your business? If you have no knowledge of your business, you're virgin eyes, so to speak, what would you be willing to pay today? And they kind of go quiet, and they let the gears turn. So upon doing so, what my customers are able to do is they're able to help their clients identify the value gap, because the two questions force the business owner to move away from their inflated number, which is very typical, and think realistically what they or someone else might pay. And this helps create a conversation to cover some of the topics we mentioned in the previous slides, where you can bring to the table how the firm takes a proactive approach to help guide their clients to a higher value, right? You can go ahead and launch another poll question. Question is, would you describe your business valuation services as execution-based or consultative? Polls in progress. Okay, we're about at 80% have voted so far. Okay, we're stuck at 80% have voted, so I'm going to go ahead and give it about 10 more seconds, and then we'll close out the poll. Okay. Taking back the results to now. This is extremely interesting. I have asked this question at almost every conference I've spoken at, and the results here are significantly different than what I've seen in person. At the conferences I've spoken at, whenever I've asked this, it is almost, I would say, closer to 80-20 or 90-10 execution to consultative. So what we're seeing here is about nearly a 50-50 break. This is very, very interesting. Maybe it's because the overall topic of the webinar, but I definitely am very excited to share this back internally and also with AICPA. And some of our blog posts as well. So thank you all for sharing. Go and hide this out now. So get back into it. So within those conversations, our customers have found essentially what-if scenarios can be extremely helpful. It provides a visual impact to the client where they simply talking about the numbers could essentially potentially confuse the client, right? The kind of deer in the headlights look, so to speak. So I'm going to go ahead and show a quick video of an elementary scenario where the practitioner is modeling a 20-day reduction in receivable days. Okay, go full screen. So we're looking at an initial discount cash flow value of $1.5 million. Using a discount rate 13.6 with a terminal growth of 3%. So I'm also looking at the net free cash flow stream. And then the practitioner modeling the reduction would then show the accounts receivable days currently sitting a little over 100. What would happen if you bring it down to 80 days? That would definitely change the free cash flow stream considerably based off the client's receivable schedule, and then also show the end client what that does to the overall value of their business. So before we move on, essentially the what-if scenarios is going to help or is helping our customers not only in their conversations when they're first talking about or identifying the value gap, but then as they're creating a conversation based around where they think the client is and where they could be, they are also able to leverage an additional step in that process where they can show a visual impact. And that really helps the client to see instead of just hearing the numbers. They can visually see it, and it really helps to create engagement, more conversation, obviously, retain that business. But getting into an action plan, essentially, in the past, BV professionals and CPAs have looked at valuation as a small part of their firm that's really an extra line of business rather than a huge revenue driver, right? So many firms are passing off BV work to someone else because they just don't have the time. So one of our recent webinars, we found out 48% of CPA firms we spoke with are outsourcing BV work. So money walking out the door and the client being exposed to local firms pitching services, basically. So firms need to realize they may lose their business clients following a sale. Then again, solid execution and communication may lead to the buyer of that business to remain with the advisor. So recently I spoke with a CPA that expressed disinterest in trying to help her business clients and prepare for an eventual sale. And this CPA didn't want to lose her client base. What I said was proactive advice is what is needed, not avoidance. The reality, clients are going to sell and move on with their lives. On the other hand, those in attendance might also realize that there's a lot of firms in their area who only want to do compliance work. There's a lot of referral opportunity for BV work that comes from local accounting firms. Some of my customers have told me they've been extremely successful in marketing their BV services to local accounting firms where within that marketing collateral they'll say, we'll do an NDA or non-compete as a part of our collaborative relationship with you. And in some cases, commissions were offered to the referring partner. So, in our last webinar where 48% of our attendees said that they're outsourcing the work for the current professionals in attendance, you might also see that as an opportunity right, where there's a lot of local firms that maybe they only want to do tax work, or maybe they like to just do bookkeeping, payroll. And if you can essentially establish a relationship where NDA or a non-compete can be established, that would give you a lot of essentially referral work, where the accounting firm referring it isn't afraid of you pitching additional services, and you know that the growth in valuation work is booming, so you know that that's a good avenue to take. Could be a very good way to go, and I know that a lot of my customers have been successful. Looking at the evolution of technology, some of the CPE conferences I've spoken at, I've asked my audience to check to see what time it is. After a few seconds, I'll ask who checked their watch, who checked their phone. Today, the bulk of the audience almost always checks their phone. So think about the old, what's that called, the ADOX mechanical calculators that weighed around 20 pounds and vibrated the desk when putting together client taxes. And then, going on the evolution from there, you'd kind of get more so into the pencil paper tax filing, where you mail it in to processing services. And then today, we have e-filing. Right? The same can be said for general ledgers, going from pencil and paper to Excel and now QuickBooks. So there's a professional, Darrell, who wrote an article, I call it ice-breaking article last year. It's titled Build or Buy, where he tackled the big question, do we build proprietary Excel models, aka homegrown software, or do we partner with technology and purchase it? He pointed out a case study where he, in conjunction with 13 other firms, including KPMG, CNL, analyzed just under 300 spreadsheets over a 13-year period. Error rates were from 11 to 100%, where they concluded that there's 5% errors for every 20 cells containing formulas. 90% errors for spreadsheets containing more than 150 rows. He also pointed out that aside from this case study, homegrown spreadsheets don't go through the level of scrutiny that a software provider goes through, and therefore he can place a higher level of trust in using his software, as well as spending more time thinking instead of building. So in conclusion, he states that based off of a $250 billable hour, a professional can afford to spend 12 hours building spreadsheet-based or Excel-based model, it being that the average cost of software in the market is around $3,000. I believe that the overall statement made in this article was the fact that the BV industry is currently going through the same process of transition out of Excel into a more scalable technology. The most important part of that transition is to find a tech partner that is the best fit for your firm and your processes, right? So obviously, what is your current valuation process? Currently, professionals I talk to use in-house tools, Word and Excel, or Excel add-ons to an existing software platform. If you ask yourself, what your current if you ask, is your current process scalable? What about talent turnover? I've had instances where I'll be talking to the head BV partner of a firm that has 9 separate locations, and I'll talk to his champion in the same conversation. His champion says, I have an Excel model, 14 slides, where I change a value in sheet 1 and it updates the number in sheet 14. And I turn and I look at the head BV partner for that firm, and I said, what are you going to do when you lose your champion right here? What are you going to do when he goes into business for himself? He takes all of that knowledge with him, right? Is your process, if you have talent turnover, is the current process something that can be taught and replicated easy? Is it something that you guys, or are you going to take basically a 30 to 60% hit? So where would you rather spend your time? Building that Excel software or thinking, which is what the clients are paying you to do, essentially. So just kind of wrap things up, we talked about the overall bulk of where the growth is. Oh, wait, sorry, I apologize. We got a poll question here. would you like to learn more about Sageworks Valuation Solution? We go ahead and launch this poll. Okay, we'll give it about 10 more seconds. Okay, so in conclusion, firms will continue to notice more clients asking questions about their value, and it's going to happen more often. Providing BV work as an execution can be profitable, but keep in mind that more often than not, the client is probably in need of consulting. There's a chance to turn what would be a one-time client into a client who you visit and consult with regularly over the next couple of years. As you grow, obviously you may want to consider what options and resources are available to you to grow or scale in growing industry. I want to help you guys maximize your opportunity, improve your efficiency, and increase your competitiveness. My name is obviously Zeb Zeiler. If anybody has any questions or want to speak to me directly, my email address is zeb.zeiler@sageworks.com. My extension is 572. And now we're going to move into questions. I'm going to go ahead and pull up. Okay, so appreciate your patience. I'm just reading through some of these questions. So here's one. For consultative work, do you typically charge hourly instead of fixed fee? I'd hope that the way that it was asked, from what my customers' feedback would be, is it would be actually either or. Some firms or practitioners really in consultative work, it's better to go with like a retainer. So maybe $3,000 quarterly retainer. It really also, in fact, depends on the size of the subject company that they're working with. But it would be normal to see a $3,000 to $6,000 annual calculation report, and then a biannual or quarterly retainer on $3,000 quarterly retainer. That'd be normal. On the slide with reducing AR days, how did that affect value? Did the increased cash from lower AR get multiple multiplied by the multiple to increase the value? No. So that's, in that video, that's a discount cash flow. So discount cash flow is not market multiple driven. It's essentially looking at the terminal value of the business based off cash flow. So in the background noise, if you were to look at the historical financials, it's about a $4 million in sales company that has an outstanding amount of days receivable in an industry collecting their receivables within 30 days. So essentially when they're able to reduce 20 days because of the abundance in receivables, the way that it affects cash flow is much higher than maybe a company with more regulated or normalized receivable schedule. It's mostly because the subject company in that projection or in that discount cash flow model had such nasty receivable days that it helped it drastically improve the overall value of the company. Is Sageworks Valuation software Mac compatible? The answer to that is yes. It's cloud-based. There are some areas within the Excel modules where you'd want to obviously you'd want to own Microsoft Office, or excuse me, you'd want to own the Microsoft suite of tools built by Microsoft and use Boot Camp or one of those programs where you can run both systems. Anything outside of the Excel module in our system, yes, it's completely compatible. It also would integrate with Excel and general ledger software. Does anybody have any other questions for me? Okay, well, I am going to go ahead and wrap things up here. If anybody has any additional questions for me or the team, please feel free to send me an email. Also, if anybody that responded they'd like to learn more, I can also shoot you a call or an email as well. My name is Zeb Zeiler, and I appreciate you guys for attending today's webinar.